Hello friends, I am Kaustav Bishwas. Today in most frequently asked question series, I will discuss on question, how can I protect my investments from inflation? 1. Invest in inflation indexed bonds, IIBs. Details. The Reserve Bank of India, RBI, issues inflation indexed bonds, which provide returns linked to the inflation rate. These bonds are adjusted for inflation, ensuring that your investment's real value remains protected. Benefits. Your principal and interest payments increase with inflation, offering a hedge against rising prices. 2. Gold investments. Details. Gold is traditionally considered a hedge against inflation in India. You can invest in physical gold, gold ETFs, or sovereign gold bonds, SGBs. Sovereign gold bonds, issued by the RBI, they not only protect against inflation but also offer an annual interest rate, making them a better option than holding physical gold. Benefits. Gold retains its value during inflationary periods and often appreciates as the rupee's purchasing power declines. 3. Equities, stocks. Details. Investing in the stock market can offer returns that outpace inflation over the long term. Focus on sectors that are less affected by inflation, such as technology, healthcare, or FMCG, fast-moving consumer goods. Blue chip stocks. These are large, established companies with a history of stable performance and growth, making them safer during inflationary periods. Benefits. Equities have historically provided returns that exceed inflation, thereby increasing your purchasing power over time. 4. Real estate. Details. Real estate investment can be a good hedge against inflation. As the cost of goods and services increases, so does the value of property and rental income. Location. Investing in growing cities or regions with good infrastructure development potential can yield better returns. Benefits. Property values tend to rise with inflation, offering both capital appreciation and rental income. 5. Mutual funds with inflation protection. Details. Certain mutual funds, like equity mutual funds and balanced funds, can offer inflation-beating returns. Look for funds with a strong historical performance and managed by reputable fund houses. Debt mutual funds. Opt for short-duration debt funds during high inflation as they are less sensitive to interest rate fluctuations. Benefits. Diversification and professional management can provide a balanced approach to inflation protection. 6. Commodities. Details. Along with gold, other commodities like silver, oil, and agricultural products tend to rise with inflation. Commodity ETFs. These provide exposure to various commodities without the need to physically hold them. Benefits. Commodities often increase in price when inflation rises, protecting the real value of your investment. 7. Fixed deposits with inflation protection. Details. Some banks offer fixed deposits with returns linked to the inflation rate. Though traditional FDs may not keep up with inflation, inflation-protected FDs adjust their rates to inflation. Benefits. Safe and guaranteed returns that protect the purchasing power of your money. 8. Diversification. Details. Diversify your portfolio across various asset classes to reduce risk and increase the chances of beating inflation. Benefits. A well-diversified portfolio can withstand different economic conditions, ensuring stability and growth. By employing these strategies, you can effectively shield your investments from the erosive effects of inflation, ensuring that your wealth grows in real terms over time. For more personalized advice, consult a financial advisor who understands your risk tolerance and investment goals. Disclaimer: investments in the equity market are subject to market risks. It is essential to read all relevant documents carefully and thoroughly understand the risks involved before investing. This content is provided solely for informational purposes and should not be construed as financial advice. For personalized financial solutions, it is advisable to consult with your qualified financial advisor, product expert, or product distributor. As registered financial product distributors, we do not charge any additional fees from our clients. Our remuneration is provided by the product companies. We distribute only products which comes under regulatory frameworks. This effort is aimed at knowledge sharing, and we do not claim the completeness or accuracy of the content. Please refrain from making investment decisions based solely on this information.